Welcome to this session on the Canadian personal income tax system. Sit back, relax, and learn how you can be better prepared for your tax filing obligations. Knowing the system and being organized can save you a great deal on personal taxes. Our objectives for this session are to generate a basic understanding of the Canadian income tax system. Second, we'll explain the different types of taxable income. And third, we will explain the difference between tax credits and tax deductions. The objectives continue with understanding how to deal with the Canada Revenue Agency. Next, some basic tax planning strategies. And finally, some simple tax saving tips. The income tax system in Canada is based upon self-assessment. What this means is that you do your job, collect your pay, incur expenses, then you report that information to the Canada Revenue Agency by filing a personal tax return each year. You must file a tax return each year if you meet any of the following criteria. 1. You have income in excess of the basic exemption. 2. You have self-employment earnings greater than $3,500. 3. If you borrowed under the home buyer's plan. Or 4. You have received a demand to file from the CRA. Even if you do not have to file, you should to ensure you receive benefits you may be eligible for, including 1. The Canada Child Benefit. 2. GST and HST credits. 3. Old Age Security, or 4. Specified provincial credits. Under the Income Tax Act, you are liable for tax if you were resident in Canada at any time during the year. If you were non-resident but earning income in Canada, such as an international student, if you were non-resident but operated a business in Canada, and if you were non-resident but disposed of capital property in Canada. When it comes time to interpret the Income Tax Act, or you have questions, always take into account Rule 1, whatever is best for the Canada Revenue Agency. It is the objective of the CRA to collect as much tax as possible. If you think it may not be deductible, it likely isn't. Most sources of income in Canada are considered taxable. Income from employment, as well as farms, fishing, or your operation of a small business, is all considered taxable. Investment income, such as interest on bank accounts, interest on investments, dividends, and capital gains. Another note on this subject is that in Canada, you need to report your world income. In other words, if you earn income from countries other than Canada, you must report this to the CRA as well. Under the Income Tax Act, everyone is entitled to a basic personal deduction. In 2025, this amount is $16,129, which means you can earn up to that amount and not pay any income tax. This amount is indexed for inflation and increases each year. At some point, you have likely heard someone say, "It's okay, it's tax deductible." While this may be true sometimes, it is not always correct. There is a very significant difference between tax deductible and a tax credit, and both have different impacts on your obligations. A tax credit reduces your tax payable after your taxable income is calculated. A tax deduction, on the other hand, reduces your taxable income and often can create a tax refund. Here are some common examples of tax credits. Remember, these may reduce your tax payable, but generally do not create a tax refund. Medical expenses such as prescription drugs, eyeglasses, dentists, and other medical practitioners. Donations to charitable organizations. Tuition and amounts paid for continuing education. You can claim a credit for eligible dependents and sometimes your spouse or common law partner. Persons with disabilities affecting their daily activities can claim an additional credit, and expenses related to the adoption of a child can also be claimed. Some key points about the medical expense credit are: first, there is a deductible based on your taxable income up to $2,833. Second, you can pool the expenses with family members living in the same home to maximize the credit. And if certain criteria are met, you can claim travel expenses. Some key things to remember about the charitable donations are: First, you get a credit of 15% of your donations on the first $200 and 29% of the amount over $200. Secondly, you can pool the donation receipts with family members living in the same home to maximize the credit. And you don't necessarily have to claim the credit in the year you make the donations. You can carry forward the credit to future years if it is advantageous. The tuition and education credit can get a little tricky. First, the tuition credit must be claimed by the student, regardless of who actually paid the amounts. Second, a parent or grandparent can then claim up to $5,000 of the remaining credit. Any unused amounts can then be carried forward to future years. Here are some of the most common tax deductions. Tax deductions reduce your taxable income, and therefore quite often trigger a tax refund. The most common are contributions to your registered retirement savings plan. Union dues and professional membership dues are also deductible. You can claim a credit for childcare expenses when the expenses are incurred for the purposes of earning employment income. If you move to a new location, you may be able to claim moving expenses if you moved for the purposes of employment. And you can also claim a deduction for alimony payments, but not for child support payments. RRSPs are a tax deduction. Therefore, if you earn $50,000 in a year and invested $10,000 in your RRSP, you would only be taxed on $40,000. Reducing your taxable income tends to generate a tax refund, but not always. Although RRSPs are pushed as a great idea, they are not good for everyone in every situation. If you have high interest debt, you should pay it down first too, if you are currently in a low tax bracket. You may want to invest in a tax-free saving account instead. But you don't have to claim them in the year you make the investment. You can defer the contributions to future years when taking the deduction makes more sense. There are some very basic things you can do to save yourself income tax, but of course, you should always discuss your situation with a tax professional before you make mistakes that cannot be corrected. The most important tip is be organized. Get yourself a file folder, envelope, or something else that you can store important receipts in throughout the year. Lost receipts for medical, donations, or childcare can end up costing you a lot of tax dollars. Get yourself a checklist. You can download one from our website. Do not believe what your neighbor tells you. Talk to a tax professional. Contribute to your RRSP weekly or bi-weekly if you can. Do not wait until the end of the year to make contributions. As society is aging, a lot of people are now able to claim this significant tax credit. If you routinely care for elderly parents or children with disabilities, you may be qualified to make a claim for this. It could have a noticeable effect on your taxes. Do you regularly get large tax refunds? Why? A large refund is the government giving back your money that they took from you all year. There are a couple of items that cause this. 1. Childcare expenses. 2. RRSP contributions. 3. Alimony or support payments. And lastly, tuition amounts. If you are getting a large refund each year, you can correct this on your payroll and have the extra money each week. Why give the government a tax-free loan of your money? There are some serious do's and don'ts when dealing with the Canada Revenue Agency. Do not make errors that could end up costing you. If the CRA calls or sends you a letter, first, do not answer their questions without talking to a tax professional. Second, do not send them anything before talking to a tax professional. And third, do not be rude. They are just doing their job. If you answer their questions or send them information, you may inadvertently give them information that they can use against you. Let your tax professional deal with them on your behalf. The Canada Revenue Agency is not out to get you, and they are not monsters. They expect you to pay what you owe on time, they expect you to keep accurate, detailed records, and they expect you to report to them in a format that is acceptable. We are frequently asked what causes an audit. There are several items that will cause the CRA to request information from you, such as 1. Large changes in your return. For example, large charitable donations where you normally don't donate much. 2. Continuing losses if you own a small business. 3. Your address versus your income. If you live in an area with large homes and large property taxes, but you have low income, they will be checking. And 4. Divorce. Angry spouses have a habit of calling the CRA to report on their ex-partner. If you owe the CRA, they have a large basket of tools they can use to collect from you. First, they can garnish your wages. Second, they can seize your bank accounts. And third, they can seize your home or other assets. The CRA's role is to collect taxes. They will do whatever it takes to get their job done. Thank you for watching. If you have further questions, please contact us via email or by calling 1-855-LEDGERS.